If your card was declined when you tried to buy silver, it wasn't a glitch or fraud protection. It was something far more serious. It was a quiet signal that the rules are changing. Not announced, not debated, just enforced. This is how capital controls begin in the real world, not with headlines, but with confusion, silence, and banking denials. Picture this scenario. You're at home, maybe early in the morning, maybe late at night. You're on a major bullion dealer you've used before. The math checks out. Spot price looks fair. You're not gambling. You're simply converting dollars into something tangible. You hit checkout, enter your card details, and then it happens. Declined. The message says insufficient funds, even though you know that's not true. You refresh your banking app. The money is there. You try again. Declined. So you call your bank up. After the wait, the explanation shifts. Now it's a high-risk transaction. Now it's enhanced review. No one can tell you who decided that buying silver is risky. No one can explain what rule you violated, and when you ask too many questions, the conversation ends. That's the moment most people dismiss and move on. They shouldn't. Banks never act randomly. They act when incentives change or when pressure is applied. And right now, the incentive is clear. Money is trying to leave the system. Every physical ounce purchased is a quiet rejection of debt-based currency. Those decisions don't show up on CNBC, but they show up in internal risk models. And the response is simple: add friction. This is not about protecting you. It's about slowing exits. When systems feel stress, they don't warn the public. They tighten controls quietly and let people blame themselves. History shows this pattern over and over again. Restrictions always start small, confusing, and deniable. Silver is not the story. It is the signal. What matters is why this is happening now and what it tells us about what's coming next. Once you understand that the decline on your screen stops looking like an error and starts looking like a warning. If this resonates, press 1 in the comments to continue to Chapter 2 or 2 to stop here. And if you value analysis that cuts through the noise instead of repeating it, subscribe to the channel and share your perspective below. To understand what's happening, ignore the explanation and study the pattern. Banks claim this is about fraud or customer protection, but fraud does not appear everywhere at once, targeting the same type of purchase across different institutions. That kind of consistency only happens when rules change at the banking system level. The first signs didn't come from headlines. They came from people comparing experiences. Declined transactions, identical warning messages, different banks, same language. At first it was easy to dismiss, but then the volume increased. What looked like isolated incidents became a repeating structure. Different platforms, same outcome. Declined without a single explanation. This is how modern restrictions are implemented, quietly and through automation. No announcements, no public debate. Risk categories are adjusted, algorithms updated, and enforcement happens instantly. Most people never realize what changed. They just feel resistance where there used to be none and assume it is their own problem. Notice what isn't being blocked. Jewelry purchases go through, luxury spending clears, entertainment transactions process without issue. The line isn't spending money. The line is converting money. When dollars are exchanged for something that exists outside the financial system, scrutiny usually appears. Once a purchase is flagged, there is usually no human review. The system evaluates behavior, not intent. Past purchases matter, frequency matters, patterns matter. To the algorithm, this isn't saving, it is simply potential capital flight. Systems don't evolve this way unless pressure is building behind the scenes. Liquidity stress shows up in controls long before it appears in headlines. Institutions restrict exits quietly and let people blame themselves for it. This isn't about silver yet. It is about recognizing the early shape of restriction while it is still subtle. Now we need to talk about timing, because timing is never accidental. This shift didn't happen in a vacuum, and it didn't happen slowly over years. It appeared suddenly, then spread fast. That alone tells you something important. Systems only change this quickly when stress reaches a critical threshold. Behind every declined transaction is a risk model, and behind every risk model is a fear the institution won't say out loud. Banks are not worried about you losing money on silver. They're worried about liquidity. They're worried about collateral. They're worried about what happens when too many people decide holding dollars no longer makes any sense. When confidence weakens, behavior changes. People don't announce it, they just act. They move quietly, one transaction at a time, converting digital balances into things that don't depend on promises. That behavior is invisible until it reaches scale, and by the time it does, institutions are already far too late. This is why the response isn't a public warning, it's friction. Small obstacles that discourage action without provoking outrage. A declined card, a vague explanation, a long hold time. Enough inconvenience to slow the flow, but not enough to cause panic. This is behavioral control, not regulation at all. History shows that financial systems rarely collapse from one event. They fracture from loss of trust. When trust erodes, exits become dangerous to those in control. That's when restrictions begin, even if they are not called restrictions yet. What matters here is not whether silver prices move tomorrow or next month. What matters is that the system is behaving defensively. Defensive systems don't do that when they're healthy. They do it when they are simply trying to buy time. Once you understand that these declines stop feeling personal, they start feeling strategic. And that realization should change how you interpret everything that follows next. To see where this leads, you have to understand how quietly control is applied in modern markets. There is no announcement, no emergency broadcast, no new law passed overnight. Control today is embedded in systems people already trust. Banking apps, payment rails, compliance language that sounds boring enough to ignore. That is exactly why it works. Every transaction flows through layers of classification, merchant codes, risk tiers, behavioral flags. When one of those categories is redefined, reality changes instantly for millions of people. Even though nothing appears different on the surface, you still have your account. Your balance still shows the same number, but your ability to act is narrowed down. This is why the explanation always feels hollow. Policy, compliance, automated review, these are not answers, they're shields. They prevent accountability while signaling obedience to something higher up the chain. And that chain doesn't lead to customer service. It leads to systemic risk management protocols. What's happening now fits a familiar pattern. When institutions sense strain, they don't raise interest rates first. They don't issue warnings first. They protect liquidity first. They reduce optional outflows. They slow behavior they can't openly forbid. The goal is not to stop everyone. The goal is to stop enough people to maintain control here. The most dangerous part is psychological. When friction is inconsistent, people doubt themselves. They assume error. They assume bad timing. They don't compare notes. That delays collective awareness, and delay is exactly what stressed systems really need. Once you recognize this, you stop asking why your transaction failed and start asking what pressure made failure necessary. That question matters more than any price chart today. At this point, the question is no longer whether this is intentional. The real question is what pressure forced it to happen now. Financial systems don't tighten access unless something underneath them is weakening. And that weakness always shows up first in places the public isn't meant to watch closely. Liquidity is the silent constraint. Banks operate on confidence and collateral, not cash in a vault. When the value of that collateral becomes unstable, everything downstream becomes fragile. Bonds lose value. Balance sheets compress. Suddenly, the system cannot afford optional outflows, especially into assets it cannot rehypothecate or control well. This is where timing matters. Rising yields aren't just numbers on a screen. Higher yields mean lower bond prices, and lower bond prices mean weaker collateral. When enough of that collateral weakens at the same time, institutions enter defense mode. They don't announce it, they adapt internally first. What looks like a simple decline purchase is actually the edge of a much larger response. A response designed to slow behavior that accelerates stress. Physical assets remove liquidity from the system permanently. Once converted, those dollars don't circulate. They don't support leverage. They don't stabilize balance sheets. From the system's perspective, they disappear completely. That's why this pressure isn't applied evenly. It targets behavior, not individuals. It discourages exits without confronting them. It buys time. And when systems buy time, it's usually because they really need it. This doesn't mean collapse is immediate, it means strain is present. And when strain is present, control becomes more valuable than transparency. That's the environment you're operating in right now. History gives context to moments like this because none of this is new. What changes is the method, not the motive. When currencies come under pressure, authorities don't start by taking assets. They start by controlling access. It's quieter, easier to justify, and far less likely to trigger resistance today. Past regimes needed armies and strict laws for control. Now they just use rigged algos. A simple code tweak achieves what Congress once did with zero debate or oversight seen. They don't ban bullion outright, they just throttle the on-ramps to a halt. The herd folds way before any real fight is even needed. This is why mapping past fiat collapses matters. History doesn't repeat exactly, but human nature does. When faith wavers, the central planners act to save the system they feed on. They spin it as stability. They spin it as safety. But the reality is the same: less freedom for the retail crowd. The real danger in this cycle is the creeping silence. There is no bell at the top, no Fed chair warning that the window is closing. You only realize it when you go to buy metal and find the premiums hiked and inventory gone. This is why stacking early is vital. Not FOMO, not fear, just prep. The fiat game runs on lag. The longer the sheep will question their gut feelings, the longer the illusion holds firm. This video isn't about calling top or spotting bottoms. It's about grasping the macro setup, and setups like this pay off for the prepared stacker, not the panic buyer. Now we must widen the lens because this manipulation doesn't exist in a vacuum. While access is tightening for retail plebs in the West, something different is happening elsewhere. Capital is not disappearing. It is relocating with purpose, scale, and urgency, flowing toward hard assets outside fragile financial promises. Across the global map, huge players are positioning quietly. Governments and big institutions don't chase headlines or react emotionally. They respond to balance sheets and hedging risk. When instability rises, they move out of paper and into physical metals they can hold store and control. Not paper exposure, not leverage, reality. What counts here is scale and synchronization. The system tolerates individual exits. It cannot tolerate a raid at scale. Retail stacking becomes dangerous only when it begins to mirror whale behavior. When individuals act like sovereign funds, pressure compounds rapidly. That is when the restrictions accelerate. This creates a wealth divide that most won't notice until it's permanent. One group stacks early quietly and with access. Another group is blocked, discouraged, and eventually priced out through friction lags and rising premiums. Over time, this separation becomes structural, not temporary. This ain't about what is fair or right. Under load, the fiat system doesn't care about fairness. It cares about survival and grip. Seen that way, these caps aren't random glitches. They are defensive moves against a monetary reset that is already in motion. At this point, the most critical mistake you can make is assuming there will be a clear, unmistakable moment to buy later. Currency resets never arrive with countdowns, warnings, or official announcements. They unfold quietly in layers, each one reducing agility while maintaining the illusion that nothing basic has changed. By the time the shift becomes obvious to everyone, real options are already gone. What you are witnessing now is not a collapse. It is a compression. The exit door narrows gradually. Convenience rots away. Transfers that once required a single click begin to require explanations, approvals, wire delays, or workarounds. None of this feels dramatic in isolation, and that is intentional. Systems under stress do not lock down abruptly unless forced. They shape behavior patiently, allowing you to adapt, rationalize, and accept control without realizing what is lost. Most people wait for validation. They want news banners, official reports, or spot price spikes to validate their fear. They want permission to stack. But confirmation always arrives after the supply dries up, never before. By the time certainty appears, freedom has already been exchanged for reassurance. And reassurance is always expensive during periods of fiat transition. This is why preparation matters more than crystal balls. You do not need perfect timing. You do not need absolute clarity. You need metal. While choices still exist, regulators rarely reverse bans once they are introduced. They normalize them. They expand them quietly. Over time, what once felt restrictive simply becomes the new baseline. What feels inconvenient today will feel standard tomorrow. What feels questionable today will feel justified later. This is how the net becomes invisible. And once control is invisible, it is rarely questioned, let alone challenged. The tightening doesn't happen all at once. It happens just fast enough that most people adjust instead of resisting. Knowing this changes how you interpret everything you see. The goal is not to spread fear. The goal is to recognize the end game we are in while awareness still provides leverage. Once you recognize the tightening, the most dangerous belief you can hold is that the choices still offered to you are neutral. In systems under stress, choices are never neutral. They are guided, incentivized, and throttled in ways that shape behavior without openly forcing it. What feels like convenience is often a corridor designed to keep flows predictable and controllable. This is where most people lose time. They assume the exchange will remain functional long enough for them to react later. They believe access will remain open simply because it always has been. But stressed systems do not fail evenly. They fail at the edges first. Access degrades in specific areas while appearing stable elsewhere. Some doors remain open, while others quietly lock, and by the time the pattern is visible, positioning is no longer proactive. It is reactive. This phase rewards early stackers not because they are smarter or informed, but because they acted before friction became normalized. Once barriers feel ordinary, people stop questioning them. They stop pushing. They adjust expectations downward and mistake adaptation for stability. The psychological shift is the real danger. When people accept reduced options as normal, control no longer requires enforcement. Compliance becomes voluntary, and voluntary compliance is far more efficient than force. Systems depend on this shift. Once it happens, reversal is rare. At this point, the question is no longer which asset performs best or which strategy generates the highest return. The real question is whether you still have sovereignty. Sovereignty erodes when action becomes conditional. When every move requires permission, explanation, or delay, control is gone. Understanding this is not about fear or panic. It is about clarity. Clarity allows you to act deliberately instead of emotionally. And in times like this, deliberate action is the difference between preservation and total loss. This is where it all comes together, because the purpose of understanding these patterns is not fear and it is not prediction. It is strategy. Errors like this don't reward emotion or reaction. They reward clarity, patience, and preparation. When systems tighten, the goal is not to outsmart them in the moment. The goal is to position yourself before pressure becomes visible. The lesson is simple but harsh. Waiting for permission is a losing strategy. Waiting for certainty is even worse. Financial history shows that the largest shifts always happen, while most people are still debating if anything has changed. By the time consensus forms, access has narrowed, spot prices have adjusted, and optionality is gone. This doesn't mean leaving the system overnight or acting recklessly. It means thinking in terms of resilience instead of gains. Diversification is not just about assets. It's about access, flexibility, and independence of decision-making. The more exits you maintain, the harder it is for any single restriction to trap you. Strategic thinking in times like this means acting early, calmly, and deliberately. It means understanding that convenience is often traded for control and that small frictions are rarely temporary. It means recognizing that preservation of wealth is not speculation, it is defense. Most importantly, it means refusing to outsource awareness. The institutions managing the system will not warn you when conditions change. Media will not prioritize your safety. That responsibility rests with you. If you've made it this far, you already know more than most. Use that advantage wisely. Share this perspective with people who are still confused by what they're seeing. Ask better questions, compare notes, stay adaptable. If this video helped you see the scam more clearly, take a moment to support the channel. Subscribe for deeper breakdowns like this, share this video with someone who needs to hear it, and leave a comment below with your thoughts or questions. Engagement matters because independent analysis only survives when informed audiences support it. The window doesn't close all at once, but it does close. Stay aware, stay strategic.